Hi everyone, my name is Bassem and today we'll be talking about the RRSP, the Registered Retirement Savings Plan. The questions that will be answered today are, what is it? Who can open one? How much can I deposit? How much can I withdraw? What are the benefits? Should I open one? And anything else I should know. In order to keep this video a reasonable length and to avoid information overload, I had to cut some stuff out, which I'll leave for an Advanced RRSP video. Again, if you like what you see, please give this video a like and subscribe to the channel. Number 1, what is it? In simple terms, the Registered Retirement Savings Plan is a financial account for retirement savings. You're supposed to put money into it every year and invest it, and hopefully it grows and grows so you can have a large lump sum to help you with your income in retirement. You can open one through any financial institution, whether it is a bank, credit union, or insurance company. You usually have the option of a self-directed RRSP where you can buy, sell, invest, or manage your own portfolio, or you can use one of the products the financial institution offers, which is usually one of their managed portfolios. Personally, I have an RRSP with TD Bank and I chose one of their aggressive portfolios. I manage my own margin account and TFSA account, so I thought I'd try my hand against what TD can offer. Next, who can open one? Technically, there's no age limit. Any Canadian with employment income who files their taxes can open one, and you should be filing your taxes every year, even if you don't earn any income. You can contribute until the age of 71, where any RRSP you have will be either taken into income or turned into a RRIF, a Registered Retirement Income Fund, where you'll be forced to take some of the savings into income. Next, how much can I deposit? This gets a little more difficult as it varies person to person, unlike the TFSA where it's a set amount for every person every year. Your personal limit is calculated as 18% of your earned income plus any unused contribution room from the previous year. However, the CRA places an annual contribution limit. In 2020, it was approximately $27,300. This is inflation adjusted, so it increases every year. Let's go through an example. This year was your first year and you earned $60,000, which is pretty good. This would give you a contribution room of $10,800. If you choose not to contribute or don't have the funds, that's fine. It carries forward to the next year. Where let's say again you earn another $60,000 and you have another $10,800 of room. If this happens again for the third year at another $60,000, your total contribution room will be at $32,400. Remember our previous calculation. Your contribution room is limited to the lesser of your contribution room or the CRA limit, which is $27,300. So your contribution room is $32,000, but the annual limit is $27,000. You can only contribute the $27,000. However, the difference, let's say the $5,000 that you have left over, that unused portion can carry forward to the next year. If you filed a return before, take a look at your notice of assessment. The CRA will always put your contribution room on this notice. Next, how much can I withdraw? That's easy. You can take out any amount, the whole thing, whenever you want. Just be wary, it'll be included in your income, causing you to pay additional tax. What are the benefits? The main benefits are obviously forced savings, income is earned tax-free in the account, and the last one I think is the biggest one, which is tax deductions on your contributions or tax deferral. Please note, this does not mean tax avoidance. Remember what they say about death and taxes. Any contribution made to an RRSP will be tax deductible in the year or any year you choose after. What does this mean? Let's go through another example. If you're earning $60,000, let's say in Ontario, and you contribute approximately $10,000 into your RRSP, this would reduce your tax payable by $3,000. This effectively reduces your earned income for the year. Remember, you're deferring the tax, you're not really saving it. When you pull that $10,000 out again, you'll have to pay the $3,000 in tax that you just saved. Another way to think about it, let's say you have $3,000 in tax to pay and you're thinking, how much RRSP can I contribute to get rid of that tax? You can't put $3,000 in. You have to put $10,000 in. because that $10,000 contribution will reduce your earned income. It doesn't reduce straight to your tax payable. Should you open one? The short answer is it varies. The long answer is it depends on two items: your current tax bracket and your current financial situation. If you're a high income earner, let's say around $80,000 to $90,000 a year, the tax savings you'll get on a contribution will be much higher than the savings you'll get making $30,000 to $40,000, where the tax bracket would be much lower. So obviously, the more you make, the more the contribution matters. Personally, I would avoid making any RRSP contributions if you're making under $80,000. I would wait until I'm in a higher tax bracket and deposit into my RRSP where the savings would be much more. The second point to consider before you open an account is your current financial situation. Will you need the funds in a year or two? Withdrawing your funds obviously comes at a tax penalty. Since this was a deduction, when the payment was contributed, it'll be added to your income when it's withdrawn, so you'll be subject to a minor tax penalty depending on your situation. I would assess your financial situation, your current savings, and make a decision. Lastly, anything else I should know? Yes, of course. I've decided, in order to keep the length of this video to a reasonable amount of time, I'll be saving discussions of the home buyer's plan and the lifelong learning plan into a more advanced RRSP lesson. But for now, we'll talk about this one final item. You can contribute to your RRSP in a certain year, but you don't have to take the deduction on your tax return in that same year. You can use it going forward. But what does this mean? If you put in $10,000 into your RRSP this year, but you know you'll be getting a big raise next year, or maybe you'll be working 2 jobs next year where your bracket will be much higher, where you'll be earning more income, the tax deferral will be that much more on your contribution. You have the option of depositing but not claiming it on your tax return. You can save it for the year when you make more money. That's the video, guys. Thanks for making it this far again. It was kind of painful, kind of boring, I know, but it's also very important to know. Hopefully the sound is working on the first try this time. I'm also working on the sound. I noticed in the last video there's a hissing noise, but please tune into my next video where I'll be comparing the TFSA versus the RRSP and which one to choose every time.